we have a decent idea what the dynamics are going to be over the next couple of years.
No, it's going to crash. Multifamily is going to crash.
Well, that's certainly what Scott Trench, CEO of Bigger Pockets, penned, Matt, in this piece. Multifamily is at high risk of continuing its historic crash in 2024. Here's why. This looks like it. I feel like it's familiar, Matt.
Oh, yeah. Well, he even notes that he wrote.
It's because last year in 2023, a very similar piece. Multifamily real estate is at risk of crashing. Here's why. So this is more of an update from the piece he did last week.
I appreciate at least, it's for. On one hand, I'm like, well, this is the same book report you wrote last year. And it's like, well, he's tracking the issue. But what I think it does, at least if I'm taking a really kind of cynical interpretation, is, well, okay, so he saw it and this is what he's been following with. Maybe that could point to a little bit of a bias and a perspective. But I also want to kind of clear the air here. A lot of the points that we'll review here in his call for a crash, they are really sensitive to one's initial position, their perspective, their bias, and et cetera. And so I want to kind of be clear about my own perspective, and I kind of hinted at that earlier. I was thinking about what were we thinking? At the same time this guy was thinking about crashes in 2023. I don't think any of us were anticipating a multifamily crash or even really interpreting it as such. We were just frustrated, uncertain. It was inactive. And when valuations did go down, we were waiting for buying opportunities that didn't materialize because valuations weren't down enough. It was like there's two ways of seeing these things, and a lot of it is dependent, and I'm going to be repeating this throughout our rebuttal to this, is viewing the future, looking forward to the future versus just seeing things that are going to happen like now or in like a couple months. There's a time frame definitely that makes Scott Trench's arguments very valid, but on the other hand, there's another completely valid viewpoint, I think, that's like, oh, this is the perspective that maybe investors are carrying into their buying and selling negotiations.
To me, it just comes off as a little bit of a lagging perspective. I think that was much more close to being a good take last year. I mean, I think the only thing I would differ for what you were saying, Matt, is, we saw the dynamics of, interest rates, knowing that would affect prices, also seeing all the loan maturities coming up, which, there hasn't been, nearly as much distress as there could have been because of that, because of all the loan modifications. But the result of the sum of it all has been price declines.
Yeah.
And, what he says in the piece of, 30 to 35% price declines. I mean, we're buying a property, Matt, that represents a 30% price decline from the peak. So prices have adjusted. It's just there hasn't been a lot of transactions. And not every price is adjusted. There's still sellers trying to get a high price. It's not. The difference between now and last year is last year all of the prices were still high. And then the bid-ask spread was more definitively wide, whereas now it's much muddier with that spread narrowing. Prices definitely coming down, but being a little bit more scattered and all over the place, with some sellers still holding on to high valuations, some markets holding on to higher valuations, some different types of assets holding on, but others that have kind of corrected down, and depending on the certain situation.
I think correction is that's the only real responsible way to characterize what happened in 2023 is a correction, because you're also coming off of huge valuation increases in 2021 and 2022.
I agree.
I go through so many articles every single week, every single day. I didn't read a single one that said like, oh, the multifamily crash continues. And again, all of the articles I read are probably biased in their own way. They want to put a sunny face on things, but it's irresistible to write a doomsaying article on the other hand. And so that would have gotten a lot of clicks, and I did not see a multifamily crash as a narrative anywhere. It was office, it was the loan maturities, it was this impending thing, but also I think that people were like, well, yeah, it could go down a lot, but man, did we make a lot of money in 21 and 22. So
and I guess,
that's my assessment.
If your definition, and I was like, okay, so what's the technical definition of a crash? A correction is 10% to 20%. Again, this is according to the internet. A crash would be losses more than 20%, or declined more than 20%.
Yeah.
So you could say that, multifamily has crashed. But I think it doesn't all crash at the same time.
Yeah.
And it doesn't, and a valuation crash, because in a liquid private market, you're not realizing a lot of these prices, because if you don't sell, you really don't feel it. It's kind of, it's phantom. It doesn't exist. Is it Fugazi? I don't know.
Yeah.
Because we're not market to market every single day. Maybe you could.
You can track citrus fruit prices, which I did, and they declined significantly.
Yes.
But they're not bought and sold like an orange.
So the difference is, there are good prices. So some prices are down, some prices are up. But the idea that it's going to be continuing to be challenging, like that's true. But there's also going to be opportunities, and let's just get into some of it. The points that he makes.
Okay, so breaking it down, he does give us. He does have his own thesis, which I think it's worth just going through his main take. And again, you can know it by the headline, but I think it's worth just kind of quoting him here. He says, "Unfortunately, I don't think 2024 is going to be much more fun for current owners of multifamily and commercial real estate. There's still a lot of room for this bear market to run, and little reason to believe in income growth or valuation growth in U.S. multifamily at the national level." He does have a good, well-organized article, and he gathers his evidence, ties it all together to make an argument. It fits together, but I want to dig into each of these points. First one, and there's 4 of them. It doesn't make sense to buy apartment complexes at current valuations. The second one, the outlook for rent growth is poor in 2024. The third, expenses are eating into multifamily profit. And the fourth is interest rates will not come to the rescue. If we could start at the first, this valuations claim, I'd love to hear your response. I've got my own notes here.
Well, they are if they are, but they aren't if they aren't. And so this is assuming that all the prices stay high and you can't buy. It doesn't make sense to buy at peak pricing when interest rates are high. True. This was much more. It's not that it's untrue today, but it's not necessarily universal. Because you can find deals. There aren't a lot of deals. We've got a deal right now that it represents even more, because it's a little bit newer property than the comp, some of the comps that we're using. It's a 30% discount to the peak, which is exactly what the projections are looking like. That represents a crash. So it's not the only deal that I've seen. I've seen a couple of deals.
And he's even saying right now, cap rates for prime multifamily assets are around 5%. Or 5.38 if you're going to go with CoStar. But that doesn't match up with current interest rates. But there's deals out there.
But talking to most buyers, brokers, most of the deals that are trading are going to be in the 5.5, kind of the 6.5 cap range right now. Again, not that a really premium product deal might not go below a 5.5 cap, around a 5 cap. 5 caps are a 5. A true 5 is about as low as I'm hearing something reasonably selling for today. But most stuff's 5.5 to 6 to 6.5. And again, most sellers still want to be in the 5.5 to 6. But the deals that are really trading are trading kind of in the 6 and 6, plus. The deal that we've got on River Club, is a 6.4% on the seller's T12. Again, for deals that were going for sub 5, it would have gone for a 4.5 cap just a couple of years ago.
Yeah. So a lot of that has happened, and it is interesting. It's like, I don't know what the lag period is or what the adjustment is. I haven't tracked it long enough to know, if it's CoStar, you add a couple percent, or if it's CBRE, you go with this one. But
you just all the cap rate, it's so hard. It's just, you really have to go off of, because so many of the surveys that I've seen, some of them I honestly think have gotten better over the last couple of years, but they're so often they're just off by 50 to 100 basis points. Where it's just like, okay, what they haven't, a lot of times they'll get the direction right and the proportionality sometimes. But usually it's like not actually. It's like there may have been a deal that traded for that high of a cap rate. But it's like, I know of most of the deals that traded, and they all traded in this lower range.
And his argument, if you kind of do assume that it's 5%, it is a sound argument. Like, there's no rebuttal to the idea that, like, with a cap rate that low, if your interest rate's higher than that, that's a bad idea. So
so it's, if you think this is absolutely the case, you just stay on the sidelines. What everyone has to understand right now is that sellers are breaking right now.
Yeah.
Like it has started. It will continue to occur throughout this year of sellers facing the music and facing reality of what real valuations. And so this part one breaks down every single day. And if you wait until Scott Trench writes an article saying that multifamily makes sense to buy right now, it's going to be too freaking late.
Yeah.
Like this is the time when this article comes out is when you want to buy.
Well, that's what I thought. Maybe he was writing this so that he could create some deals for himself.
I don't know.
But this is another question I have. Would it be off base to say, or would people be interested in selling because they want to buy after it, or like or kind of free up cash or something? But,
100%. I mean, that's why the seller of this property, it's not like really super distressed. They've just owned it for like 17 years and they're making a lot of money off of it. They would have made more money if they sold it 2 years ago, but they didn't sell it 2 years ago. But they kind of know where the market is, and they have another property they're buying. It's a 1031, and they need to sell it. And they want to roll into the next deal. Okay,
and I wonder, that may be a little bit of an element as the prospects look a little good. Maybe if it's good for buyers, then I'll sell it and I'll buy it.
No. There's a lot of people who miss the boat on selling in the peak of the market who are like, I'd like to get out of this deal and move on to something else. Yeah. And now they're just waiting for really interest rates to recover.
Yeah. So that's another
go down. So cap rates can.
So it's kind of the heart of my rebuttal is to look at the future and not the present. Higher interest rates are driving cap rates high, and maybe there still could be a little bit higher, but people are looking forward. Not as crazy as the Dow Jones did. Every time an inflation rate comes in, they're thinking about March and the future. But people are saying like, well, these interest rates do have to come down. Something crazy would have to happen for them not to, and I think that is a safe non-insane assumption to make. He thinks that rates are going to be at 4.5%. This is later in it, but I think that it's not going to. I think the Fed has their dot plot.
The 10-year or Fed funds?
He was saying that for the Fed funds, and then he was extrapolating.
4.5. Well, 4.5 is 100 basis points lower than it is today.
Yeah, I think that it could get to 4.5. It could possibly get to 4.5 this year, and then maybe is the neutral rate the one was like, we're going to stick with this? Maybe 3.5%. I don't know, but that's not insane. It's not like I'm not being rosy cheeked or rose-colored glasses and trying to say like, oh, don't worry, things are going to be back to the way it was. I'm just saying that it is not at all. I think it's more reasonable than not to suggest that the stuff that doesn't make sense right now is going to improve, and it may be worth carrying those assumptions into your buying decisions. So that's my rebuttal to part one.
You don't want to over speculate, but you have to at least kind of see where things are going now, where they've been, especially when things are obviously moving. But I do think that the rates aren't going to get low as soon. This is where I guess I agree with what Scott is saying, is that they're not going to get low as soon as some people wish they would. Because there's been anticipation that rates would be down at the end of 2023.
That was some of our discussions at the start of 2023. It's like, all right, the rate cuts are going to start this year, right?
That's what a lot of people
did not
thought.
see it. Yeah,
no, did not happen.
So,
all right. So part two, the outlook for rent growth is poor in 2024. That's not. That's not untrue, Matt. The rent growth outlook is not great, but it's so location dependent, though, right? And was more true for 2023 rather than 2024.
I agree too.
But we do have a lot of supply coming online. It's not going to be a great year for rent growth, so it's not untrue. It's just, again, it just seems like it all just seems a little like stale, not untrue. Still, it's still edible. It's just a little. It's a little stale. Yeah, it's
I agree. So
it's consumable.
I like that one of the descriptions that he has of the incredible amount of multifamily supply. He's like, the only word I have for this massive supply is an onslaught. He argues that this construction boom is accelerating. So that is his picture of multifamily supply. Is yes, we're going to get supply. But and I'm not even going to. I'll address his his comments on demand too. But he does have a pretty detailed breakdown of the fundamentals of apartments that would drive rent growth and not rent growth. But yes, he says that the construction boom is accelerating. I don't think that's the way it looks.
What is the data show?
So the data shows if you look at permits and you look at starts, not necessarily completions. Well, first of all, the completions expected in 2024 from a bunch of private sources are less than the ones that are expected in 2023 for some of them, or at least equal. Not necessarily accelerating, because as you can see in this chart here, we have starts, completions, permits, and units under construction, 4 lines in the line graph, and the ones for permits, which happen at the earliest among these things. So this is where the government says, okay, you can build here. It's like not the very beginning of a project, but a start of a project. Those permits are going down and have been going down since really dramatically since 2022 and when the interest rates started rising. And also, since 2022, the amount of housing units started has gone down. These are multifamily units with 5 or more units. That's the metric that people use. So the permits and starts are going down. That to me would indicate that the completions will be going down in the future, and that is the expectation that a lot of different sources are using. CoStar themselves has like 250,000 completions expected for 2026 compared to the 500 or so expected now. So the reason is they're looking at construction guys can't get loans. Just like us syndicators can't get loans. They're not starting building, we're not buying, and things just stagnated a little bit in 2022. Didn't fall off a cliff, but still very much a slowdown, and you can't say it's accelerating. So that's a hard and true rebuttal there.
Yeah, I just think it's not untrue. It's just a little stale.
Yeah,
and then another part that it's true, but it just again rings a little stale again, which is expenses eating a multifamily profit. This is definitely the case. We've talked about property taxes, we've talked about insurance, especially in markets like Florida, in Texas, even in Georgia, payroll, utilities.
Yeah.
Overall, turnover costs, contracting services. It's all gone up. But a lot of that we saw at the beginning of 2023 and 2023. If anything, we've seen prices more or less normalize. Okay. Not that they're going down, but they're not going up just like the rest of inflation.
Yeah.
It's more or less normalized. So, the statement expenses eat into multifamily profit. Well, that's always true.
Yeah.
And expenses rose last year, but this to me seems like an issue that is a little bit more in the past. Yeah. Now, if you combine it with Port 2, that's like, you've got some decent expenses and rent growth is going to be, basically expense growth and rent growth, maybe you're going to be on par. In some markets, expense growth maybe higher than rent growth if you have negative rent growth. The Sun Belt's going to have some challenges. Spots like Austin and Tampa and Phoenix.
He used insurance as one of the major examples. He also used in a strange way that he said that tax increases due to newly assessed value increases are another source of extra expenses. Yeah. And that may be the case. I think the general picture of expenses, at least, and I'm not in the weeds like our property management team or accountant team, but everything I've heard, and even from professional reporting on this issue, is that they're plateauing, maybe a little bit, not decreasing, but definitely the expenses are no big negative surprises expected in 2024 when it comes to like your utilities bill or. But that being said, if you're talking about these tax increases, I think that to cite valuation increases, even if they are, to further your point about rising tax expenses, to cite valuation increases as part of an argument for valuation decreases, that's a mixed evidence,
well,
right?
What must go up must come down, I guess.
Yeah. So, but if your larger point is that multifamily valuations are decreasing, to use evidence as I guess what comes up must come down. That's a good point.
Overbought, I guess.
Yeah.
But not always the case.
Yep.
Yeah. Again, it's a little bit of circular logic, but it's, I don't know. It is what it is. It's
ultimately, summatively, that's nitpicky, and I'll throw that one out. But summatively, I don't think that the expenses is not as strong of a point as it was in 2023.
Agreed, and which is kind of the key point across all these takes. And then same thing. Well, this one I think is mostly true, which is interest rates will not come to the rescue. I mean, I think it depends because, again, every property is different. Every loan is sort of a little bit different in terms of the leverage and the deal. When it expires. If you bought a 2 cap in Houston and you need the interest rates to come back down to 0 to be able to sell it at a 2 cap rescue again or a 4 cap, nothing's going to save you. Sorry. But if you bought a decent deal and it's on the margins and you go from having to bring a couple $100,000 of cash and refinance to cash out because interest rates came down, it is going to help you. Maybe it's not a full rescue, but it's going to give hope. And I'll give some actually real pushback, I guess, because the idea, not that the interest rates have already moved, but that interest rates will decrease, has given banks the green light and the optimism to modify all these loans. So the interest rates don't even have to lower. It's just that they have consensus and enough groupthink to say, well, we've been told that there's going to be 4 to 6 interest rate cuts this year. I'm like, 6 interest rate cuts? No. They're like, well, that's what we're being told. And since we're being told that by our smart guy that's above us, our director of market smartness.
I want that job.
Isn't that your job?
That's right.
That's what they told us. And so, we're going to modify loans because we think rates are going to come down. If not, we'll deal with it then. But again, we don't want to write things off on our own book and mark to market ourselves. And we've been given the data points from on high to kick this can down the road. So again, interest rates don't even have to lower. It's just the perception that they will lower has already rescued many borrowers and without the rates even having to come down.
I took issue a little bit. It seemed like the and again, I'm still thinking about like the current moment versus whatever future projections that are coming in to people's thinking when they're buying and selling. So maybe people go in and they're like, well, I'll just refinance. And now that's really dangerous. I feel like to like bank on interest rates going down as part of like your core business plan of buying a multifamily property. But it is slightly an element.
It's not insane to think, but I mean, when we on the deal that we've got right now, we looked at a couple different execution methods, financing and the financing strategies, and we looked at going a bridge to where we would have to refinance in 2 or 3 years, and with some conservative modeling, that objectively was a way to achieve higher returns. And even with some conservative assumptions on the refinance, and again, you could get crazy with the assumption on the refinance and make it look really good. But from our base case scenario, it didn't look so much better that it was worth taking the risk. And so we decided, let's just go fixed rate, even though maybe we're going to leave some money on the table because there'll be a higher prepayment penalty. But where interest rates are going to go, what terms are going to be in 2 years, there's so many variables.
It's too speculative.
It's too speculative. You can do it just to see what it looks like, but it's not very useful. Models are they're the aberration of usefulness. When they're essentially like a little bit more accurate than tarot cards.
That's great. But I wonder, though, if there is a little bit of an expectation that's built into the market, whether it's, the thoughts of brokers saying you can get this price because, I know it's crazy interest rates now, but think about what's going to happen in the future. Or that could just be a factor in discussions. But what Scott Trench seems to be saying here is that interest rates are not going to fall much further than the 4.5% that they are. I agree. I think that rescue is a good word because this is an issue.
If you're counting on it falling further than 4.5%, you need it to.
If you need it to, if you want
up the river without a paddle.
Yeah, exactly. Like if you're in that position already and you need to be rescued, that's not going to happen. But in terms of like if you're a syndicator and you want to keep your business going and still keep the acquisitions and if you're looking for things to buy or something, like there's a potential for deals to make sense. But you probably aren't going to assume that it's going to stay at 4.5% for the next, for 2025 and on. But that he seemed to imply in here that it would stay at 4.5% for longer than after 2024. And I'd like to scroll down, but
I don't think he's necessarily incorrect on that. Again, we don't know where interest rates are going to be in a couple of years from now. But I think that, we've got a lot of growth going on in the United States. Mm-hmm. I think we're going to see, we're going to have a decade of, a little higher growth, higher inflation, and slightly higher interest rates, which is kind of much more normal than the last decade we had.
And I, rebut my rebuttal. I'm sure that Scott Trench will.
No, it's a well put together piece. Again, I think that he was spot on last year. I think that there's a little bit more nuance, and he gets into some of the nuance. But I think that we're starting to see some of the market break that some of these assumptions were based on. Again, some of these I think the interest rates will not come to the rescue. Again, you have to just put a qualifier on all of these. For all expenses each to multifamily profit. So as they always do. And less this year than last year. Rent growth is poor, but less this year than last year. And it doesn't make sense. Well, I think it depends. Again, less this year than last year.